Good day, everyone. Welcome back to Introduction to Financial Accounting 2. Today we are looking at Chapter 14, which is titled Corporations, Dividends, Retained Earnings, and Income Reporting. And as always, we will begin with the learning objectives for today's lecture. So the first learning objective is going to be to try to explain how to account for cash dividends. And then we're going to try to explain how to account for stock dividends and splits. After that, we're going to try to learn how to prepare and analyze a comprehensive stockholders equity section. And finally, we will try to describe the form and content of corporation income statements. So let's get into it. Now let's start with the first learning objective, how to account for cash dividends. First, let's try to understand what dividends are. Dividends are basically a distribution of cash or stock to stockholders on a pro rata basis, basically meaning that the distribution is going to occur in proportion to each owner's ownership percentage in the corporation. Now, these dividends can take multiple forms. Could be a cash dividend, property dividend, or a stock dividend, or scrip, which is a promissory note. And these dividends are generally reported quarterly as a dollar amount per share. Now, for a corporation to be able to actually pay cash dividend to its investors, they need to satisfy three conditions. They need to have retained earnings, they need to have adequate cash, and they need to have a declaration of dividends by the board of directors. When dealing with cash dividends, there are three dates that you need to pay attention to. The first is the declaration date. Basically, on this date, the board of directors would authorize the dividend distribution. And then we have the record date, which is the day in which the shareholders get registered, or the registered shareholders on that day would be eligible for dividends. So if you own the stock on that day, you would be eligible to collect the dividend. And then we have the payment date, which comes after at the end, which is basically the day where the company is going to disperse those dividends to the investors' accounts or issue the dividends. Now let us look at an illustration to try and understand what kind of accounting records that are going to be recorded on the company's books. The illustration says on December 1st, the directors of Media General declare a 50 cents per share cash dividend on 100,000 shares of $10 par value common stock. The dividend is payable on January 20th to shareholders of record on December 22nd. Now notice, here we have the declaration date and the date of record and the payment date. When it comes to the declaration date, on that date, we're going to need to record the following transaction. We're going to need to debit cash dividends and credit dividends payable, right? After that, on December 22nd, which is, according to our illustration, is the date of record, we're not going to include, or we're not going to record anything. But finally, on the payment date, we are going to record the actual payment of the dividends. So now we're going to debit dividends payable and credit cash. Remember our discussion earlier in this course about preferred stocks, right? Now you must know that the preferred stockholders have a priority or have a preference over common shareholders. So the preferred stockholders have the right to receive dividends before common stockholders. Now, per share dividend amount is stated in the case of preferred stockholders as a percentage of the preferred stock's par value or as a specified amount, depending on the agreement between the company and the preferred stockholders. And the preferred stockholders must also be paid both the current year dividends and any unpaid prior year dividends before common stockholders receive any dividends. So the leftover after satisfying the conditions of the preferred stockholders agreements and paying the dividends for the preferred stockholders, if there is any amounts left over, then that amount or those amounts are going to be distributed to the common shareholders. Here is an illustration on cumulative dividend. The illustration says Scientific Leasing has 5,000 shares of 7%, $100 par value, cumulative preferred stock outstanding. Each $100 share pays a $7 dividend. So that's a 7% out of each $100. The annual dividend is 35,000, which is 5,000, the number of shares multiplied by $7 per share. If dividends are 2 years in arrears, preferred stockholders are entitled to receive the following dividends in the current year. So that would be the dividends in arrears, current year dividends, which is 35,000 based on our calculation before. As we mentioned, $7 multiplied by 5,000, the number of shares. And that will be the total, that will give us the total preferred dividends for that year, which is basically the dividend for the current year and any cumulative dividend from previous periods. And again, to reiterate, as we mentioned before, allocating cash dividends between preferred stockholders and common stockholders needs to provide priority to the preferred stockholders. So holders of cumulative preferred stock must be paid any unpaid prior year dividends and their current year's dividend before any amounts are or any dividends are given out to common stockholders of the company. A quick illustration to showcase allocating cash dividends. The illustration says on December 31st, 2017, IBR Incorporation has 1,000 shares of 8% $100 par value cumulative preferred stock. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2017, the directors declare a 6,000 cash dividend. Prepare the entry to record the declaration of the dividend. So now the entry that we're going to need to record for this is basically we're going to need to debit cash dividends, 6,000, and credit dividends payable, 6,000. Now to calculate the amount that is going to be paid out for preferred dividends or preferred stockholders, we're going to calculate it by the number of preferred stocks that we have issued, which is the outstanding preferred stock, which is 1,000 shares, multiplied by the par value, which is $100, and then multiply it also by the percentage or the rate for the preferred stockholder, which is 8%, and that is going to give us $8,000. Now notice what's going to happen. So at December 31st, 2018, ABR declares a $50,000 cash dividend. We need to show the allocation of dividends to each class of stock. Now from the previous year's information, we know that we as a company or IBR company have declared $6,000 to be distributed, and we calculated that the preferred stockholders need to be paid $8,000. But since the company is only giving out $6,000, so all of that $6,000, as you can see on the 2017 column, is going to go to the preferred stockholders, right? So the allocation to preferred stockholders is going to be 6,000. Nothing is going to remain for the common stockholders, so they're going to get zero. In fact, we were supposed to pay the preferred stockholders $2,000 more because they should be paid $8,000. So what we're going to do, notice on the following year, since we are giving out, or the company is giving out $50,000, dividends in arrears for the previous year is going to be $2,000. How did we figure that out? Basically, the amount that the preferred stockholders should have been allocated was $8,000. But since we only gave them $6,000, so now we're going to calculate it by taking $8,000 minus $6,000, the amount we already paid out to them, and the difference is going to be $2,000. So that is going to be our dividends in arrears, and then the allocation to preferred for the current year, 2018, is going to be the actual amount we calculated from the previous slide, which is 8,000. So for this year, we're going to give the preferred stockholders 10,000. That 10,000 is going to be taken out of the 50,000 that we allocated to the dividends. So the remaining 40,000 is going to go to common stockholders. Now, how are we going to enter the record for this transaction? Here on this part, the question is asking you to prepare the entry to record the declaration of the dividend. So basically, this is going to be a debit to cash dividends of 50,000 and credit to dividends payable 50,000. Now, for any do-it-yourself exercises, I'm going to skip over. Feel free to pause the video and practice these exercises on your own. Now for the second learning objective, we already covered cash dividends. Now we're going to look at how to account for stock dividends and splits. Now for stock dividends, these are basically pro rata distribution of the corporation's own stock to the stockholders. So instead of the company giving out cash dividends, they're going to pay the dividend in the form of extra stocks, right? Now there are multiple reasons why a corporation might issue stock dividends instead of paying their investors in cash distributions. First, to satisfy stockholders' dividend expectations without spending cash. Second, to increase marketability of the corporation's stock. And third, to emphasize a portion of stockholders' equity has been permanently reinvested in the business. There is another very important reason for a corporation to actually issue stock dividends instead of giving out cash dividends, which is not mentioned here. That relates to taxation. In many countries, dividends are treated as income to the investors, so they are taxed at a higher rate than capital gains. So some corporations might decide to pay out stock dividends instead of cash dividends to protect their investors from paying income tax on their cash distributions. So from tax perspective, it is better for the investments in most cases. Depends on the country's rules and regulations when it comes to taxing cash dividends. It is also worth knowing that stock dividends might be considered small stock dividend in the case that the stock dividend represents less than 20 to 25% of the corporation's issued stock, and in that case, the issued stock or the stock dividends is going to be recorded at fair market value. In the other case, the stock dividend is going to be considered large stock dividend when the percentage of the stock dividend represents greater than 20 to 25% of issued stock, and in that case, the stock dividend is going to be recorded at par value. Now let's see, how do we record a stock dividend issue. This illustration says Midland Corporation declares a 10% stock dividend on its 50,000 shares of $10 par value common stock. The current fair market value of its stock is $15 per share. Record the entry on the declaration date. Now the entry for this is going to look like the following. We're going to debit stock dividends, and we're basically going to calculate this by the number of outstanding shares, which is 50,000 shares. We're going to multiply it by the percentage of the dividend, which is 10%, and multiply it by the current stock price in the market. So based on that, we're going to have 50,000 multiplied by 10% multiplied by $15, and that is going to give us $75,000. Now this is going to be debited against a credit to common stock dividends distributable of $50,000 and paid in capital in excess of par for the common stock of $25,000. Now how did we calculate this? We calculate this by the number of shares, or the difference between the par value of the stock and the current market price for the stock. So the paid in capital is going to be calculated as you can see in the statement presentation at the bottom. The common stock value, based on par value, of course, is the multiplication of 50,000 shares multiplied by 10. That's going to give us 500,000. And then common stock dividends distributable is 50,000. And the paid in capital in excess of par for common stock is 25,000. So based on that, we know that the total paid in capital in this scenario is going to be $575,000. So that was the entry to record on the declaration date. How about when Midland actually issues the dividend shares? When the company issues the dividend shares, we're going to need to record the following transaction. We're going to debit common stock dividends distributable, and we're going to debit that 50,000, and we're going to credit common stock for the same amount, 50,000. Here we have a really good illustration to show us the effects of stock dividends. So notice here, what do we have? We have the situation of the company before the dividend, and then we have a column for the change, and a last column that shows what is the position of the company after the dividend is issued, the stock dividend. So the stockholders' equity, as we learned how to report, we're going to have paid in capital, starting with the common stock at $10 par value. For the initial position, as we mentioned before, is 500,000 because we have 50,000 shares at $10. And then we don't have any paid in capital in excess of par. So the total paid in capital is going to be 500,000. And here they are giving us that the retained earnings for this company is $300,000. So the total stockholders' equity in this scenario is 800,000. And the total number of outstanding shares is 50,000, as we mentioned, at a par value per share of $10. Now, after the stock dividends is issued, we're going to have the following changes. The common stock value is going to increase by 50,000. And the paid in capital in excess of par is going to increase by 25,000. This is what we got from the recording process that we've done in the previous slides. So based on that, the total paid in capital is going to increase by 50,000 plus 25,000. That's going to give us 75,000. Now, where is that money going to come from? That is going to come from the retained earnings of the company. So based on that, we're going to subtract the same total from the retained earnings row, and the total stockholders equity based on that is not going to change because the increase is going to occur to the total paid in capital, and the same amount is going to be subtracted from retained earnings. So as in total, the stockholders equity value is not going to change. However, the outstanding shares number is going to increase by the number of stock dividends that we're going to issue. In our example here, we have 5,000 shares that are going to be distributed. So based on that, you can see the position of the company after the dividend, the stock dividends is issued. Now the common stock value is going to be 550,000. The paid in capital in excess of par is going to be 25,000. The total paid in capital is going to become 575,000. And the retained earnings is going to decrease to 225,000. The total stockholders equity is going to stay the same. The outstanding shares is now 55,000 shares, and the par value per share is going to stay the same, which is $10 per share. Quick review question: which of the following statements about small stock dividends is true? A debit to stock dividends for the par value of the shares issued should be made. B, a small stock dividend decreases total stockholders' equity. C, market value per share should be assigned to the dividend shares. Or D, a small stock dividend ordinarily will have an effect on par value per share of stock. And the correct answer here is C. So the market value per share should be assigned to the dividend shares. Here's another one. In the stockholders' equity section, common stock dividends distributable is reported as a deduction from total paid in capital and retained earnings. Or B, current liability. C, deduction from retained earnings, or D, addition to capital stock. As we saw from our previous illustration, it is going to be reported as an addition to capital stock. So the answer is D. Now let us talk about stock splits. Stock splits are basically the issuance of additional shares to stockholders according to their percentage of ownership. It results in a reduction in the par or stated value per share, and it increases in number of shares outstanding. It also reduces the market value of shares, but there is no journal entry required. Let us now try to see the effect of a 4-for-1 stock split. For example, here we have a company called ABC Company having their ownership, 40% of their ownership traded in the stock market. If they decide to do a 4-for-1 stock split, assuming that they had 4 stocks being traded, now this number is going to multiply by 4. So each stock is going to be divided into 4 stocks. So the number of shares owned will increase, but the percentage of the company owned remains the same. Going back to Midland Corporation that we covered earlier, let's see the effects of Midland Corporation, assuming that it splits its 50,000 shares of common stock on a 2-for-1 basis. Now, before the stock split column, as you can see, we had a common stock valued at $500,000. We had no paid-in capital in excess of par for common stock. So we had a total paid-in capital of $500,000 and retained earnings of $300,000. So the total stockholders' equity was $800,000. The number of outstanding shares, 50,000 shares. The par value per share, $10. Now, for the change, the only thing that is going to be adjusted, as you can see, is the number of outstanding shares. So the number of outstanding shares is going to double because we're splitting 2-for-1, remember? So instead of having 50,000 shares as outstanding shares, now we're going to have 100,000 shares. In return, the par value per share is going to be cut in half. So instead of having $10 par value per share, this number is going to drop down to $5 per share. So as you can see, the number of shares will double. The par value per share is going to be cut in half. So basically, nothing much is changing. Only those 2 factors. So if you look at the paid-in capital numbers, the common stock, the total, the paid-in capital in excess of par for common stock, the total paid-in capital numbers, the retained earnings, the total stockholders' equity, nothing is changing. The only change is for the number of outstanding shares and the par value per share. Here is an interesting insight about Berkshire Hathaway. Those of you who are interested in stocks and investing in the stock market probably heard of this company before. This is Warren Buffett's company. Warren Buffett's company, Berkshire Hathaway, has 2 classes of shares. Until recently, the company had never split either class of stock. As a result, the Class A stock had a market price of $97,000 and the Class B sold for about $3,200 per share. Now, this is a kind of an old article. The prices has increased dramatically since then, but let's keep reading. Because the price per share is so high, the stock does not trade as frequently as the stock of other companies. Buffett has always opposed stock splits because he feels that a lower stock price attracts short-term investors. He appears to be correct. For example, while more than 6 million shares of IBM are exchanged on the average day, only about 1,000 Class A shares of Berkshire Hathaway are traded. Now, despite Buffett's aversion to splits, in order to accomplish a recent acquisition, Berkshire decided to split its Class B shares 50-1. Again, this is a do-it-yourself exercise for the second learning outcome. Feel free to pause the video and do this exercise on your own. Moving on to the third learning objective for today's lecture, we Going to look at how to prepare and analyze a comprehensive stockholders equity section. We've done this in the previous chapter. However, now we're going to see how we can add retained earnings to this section. We've mentioned already that retained earnings are basically net income that a company retains in the business. This is mainly generated by the company's activity or revenue generating activity. The retained earnings represent a part of the stockholders' claim on the total assets of the corporation. And if we look at the example that we have here, where we have a retained earnings deficit, this will represent a debit balance in retained earnings. So this debit balance to retained earnings is identified as a deficit to this account. Retained earnings may have some restrictions. These restrictions may be a result from some legal framework, some contractual restrictions, or voluntary restrictions. Retained earnings may also be used to adjust for prior periods, to correct any errors that were present in the financial statements of the company that was issued previously. These could be the result of mathematical mistakes, mistakes in application of accounting principles, or oversight or misuse of facts. These adjustments made to the beginning balance of retained earnings. So let's take a look together at how we can carry out these adjustments. Here we have an example for Woods Incorporation. This is the statement of retained earnings for the year ended December 31st, 2017. Here we can see the opening balance for this statement, which starts on January 1st, 2017, starting from $1,050,000. And then we can add the net income for the 2017 year, which is 360,000 as given to us. And we're gonna take out any dividends paid out to our shareholders. With this, we can close the balance for the current year, 2017. So we're gonna close it at 1,110,000. Now, this example tells us that before issuing the report for the year ended December 31st, 2017, you discover a 50,000 error net of tax that caused the 2016 inventory to be overstated. Here, they also tell you that overstated inventory caused by cost of goods sold to be lower and thus net income to be higher in 2016. Would this discovery have any impact on the reporting of the statement of retained earnings for 2017? So let's take a look together. Now, the answer to the previous question, of course, yes. This needs to be adjusted on the statement of retained earnings for Woods Incorporation. So let's see how we can do this. As you can see, we have the balance on January 1st. And now we're going to add, as previously reported, which is the 1,050,000 that we mentioned earlier. But then we're going to adjust it using prior period adjustments. And the justification here is for an error correction. And we're going to deduct that $50,000 that we discovered that it was overstated in the previous statement. That is going to give us the balance as restated of $1 million only. And again, we're going to continue normally with the statement. So we're going to add net income and subtract dividends. And at the end, we're going to get the balance on December 31st, which is 1,060,000. It is worth knowing that retained earnings account is a type of equity. So let's see how debits and credits are carried out to retained earnings. Here you can see the representation of the T account for retained earnings. And we already seen that net loss is reported as a debit to retained earnings. On the other hand, if we have a net income, we're gonna credit retained earnings account. So net loss would debit retained earnings, net income credits retained earnings. We could also debit or credit retained earnings in accordance with any prior period adjustments or overstatements of the net income. In the case of overstating net income from previous periods, we're going to debit retained earnings to reduce it or to reduce its balance. And if we have understatements, that means we have reported lower retained earnings for the previous year by mistake, and now we want to increase it, then we're going to credit retained earnings. Retained earnings also could be debited for cash dividends and stock dividends when we give out some dividends to our investors, and it could be debited for disposal of treasury stocks as well. If we understand the debit and credit rules that we just mentioned earlier for retained earnings accounts, it makes it easier for us to represent our retained earnings statement. So now here we have this example for Grabber Incorporation. They had a balance or a starting balance for their retained earnings of $1,050,000. We have a correction for understatement of net income in prior period. Remember that we said any prior period understatement correction is going to be credited to retained earnings account, and the credit accounts increase retained earnings account. So based on that, we're going to increase 50,000 for this adjustment. So we're going to add 50,000, and we also we now going to end up with a balance on January 1st as adjusted of 1,100,000. We also mentioned that net income credits retained earnings. So based on that, we're going to add net income. The net income we have here is 360,000. So we're going to add that, and we're going to end up with 1,460,000. Now, on the other hand, we said that cash dividends or stock dividends are treated as or recorded as a debit to retained earnings account. So we're going to subtract those. These are 100,000, 200,000. So we're going to add them together. We're going to get 300,000 that we need to subtract from our balance so far. And based on that, we're going to have an ending balance as on December 31st of 1,160,000 for the retained earnings of Garber Incorporation. Quick review question. All but one of the following is reported in a retained earnings statement. The exception is cash and stock dividends, or net income and net loss, or some disposal of treasury stock below cost, or sales of treasury stock above cost. And the answer here is D, sales of treasury stock above cost. This slide showcases a comprehensive stockholders equity section for Grabber Incorporation. This shows you the complete stockholders equity section and the different items that are included on this section. So feel free to pause the video and familiarize yourself with the accounts represented on this statement. We have already seen how the stockholders equity section of the balance sheet of a company would be represented. It is also worth knowing that this section, or analyzing the balance sheet of a company, is a common practice for stakeholders of any corporation. You might have done financial statement analysis course, or you might do it in the future, and you will learn how to analyze the balance sheet of a company. Here we have a quick example that we can see how is this done. So the illustration we have here talks about Walt Disney Company. It says Walt Disney Company's beginning of the year and end of the year common stockholders equity were $31,820 and $30,753 dollars. These numbers are given in millions, respectively. Its net income was 4,687 million. So that's basically 4,687 million, and no preferred stock was outstanding. So based on this, we can take a look at the net income minus preferred dividends, so 4,687,000,000 minus $0, divided by average common stockholders' equity. How do we get the average common stockholders' equity? We basically take the beginning uh, beginning of the year stockholders' equity plus the ending of the year stockholders' equity. We add them together and then divide them by 2. Now this formula is going to give us the what is called the return on common stockholders equity, or return on equity, ROE, and in this example it comes up to 15% return on equity. So this is a ratio that is used in financial statement analysis that relates to stockholders equity in particular. And the ratio shows how many dollars of net income the company earned for each dollar invested by the common stockholders' equity. So this is a really important metric that helps investors, for example, to gauge the profitability of their investment in a certain company. So we can use this ratio to take investment decisions. If we assume that everything else is equal between two companies, and we are basing our investment decision solely on the return on equity ratio, we would prefer a company with a higher return on equity. So if we assume that Walt Disney had a 15% return on common stockholders' equity, and we have another company that offers 30% return on equity, then we will choose to invest in the second company, which has a higher return on equity percentage. Here is the do-it-yourself exercise for the third learning outcome. As always, feel free to pause the video and give it a go. Finally, we're going to move on to the fourth and last learning objective of today's lecture, which is to describe the form and content of corporation income statements. You might be familiar with income statements from your study in Accounting 1, but here we're going to revisit this really quickly and see how income statements are represented with income taxes. This is for Leeds Incorporation, their income statement for the year ended December 31st, 2017. As we know, we're going to begin this with the sales revenue. This company had $800,000 of sales revenue, and then we're going to take out cost of goods sold, in this case 600,000. That's going to give us a gross profit of 200,000. Now we also subtract operating expenses. We have 50,000 in this case, and that's going to give us the income from operations of 150,000. Now, if the company has any other revenues or any other gains, we add that, in this case 10,000. And if they have any other expenses and losses, we're going to subtract them. In this case, we have 4,000 of other expenses and losses, so we're going to deduct that. And all of this is going to give us the income before income taxes of 156,000. And then we're going to apply the tax rate that is applicable to the company to calculate the income tax expense that the company needs to pay. In this case, it's 46,800, and we gonna come down to the bottom line of the income statement, which is net income, and in this case, it's going to be $109,200. Moving on to the income statements analysis. Now, income statements are one of the main reports that are thoroughly analyzed by financial analysts. But one of the key metrics that these analysts use to analyze income statements is the use of EPS. EPS is basically earnings per share, and this ratio is calculated as follows. Earnings per share would equal net income minus preferred dividends divided by weighted average common shares outstanding. The EPS ratio indicates the net income earned by each share of outstanding common stock. So it's a measure of profitability of the investment in a company. Now, This is used also to set or to gauge if the company had met market expectations. If you are interested in the stock markets, you'd usually see that analysts would set an expected EPS for the company before the company announces its quarterly announcements. So they would say that this company is expected to earn, let's say, 20 cents per share. So the EPS or the expected EPS for the company is 20 cents per share, for example. And then once the company announces its actual statements, uh, this has a direct effect on the stock price. In the case the company exceeds the expectations and achieves, let's say, 25 cents per share, and it has a negative effect on the stock price in the other um, scenario as well, where the company falls short or does not meet the expectations and maybe only achieves, let's say, 15 cents per share. Let's try to calculate EPS with this example here. It says the income statement for Nadine Incorporation shows income before income taxes of $700,000, income tax expense of $210,000, and net income of $490,000. If Nadine has 100,000 shares of common stock outstanding throughout the year, earnings per share is going to be A, $7, or B, $4.90, or C, $2.10, or D, no correct answer is given. And the answer here is B, and we're going to calculate this based on the following formula: 490,000, which is the net income, divided by the common stock outstanding number or outstanding shares of 100,000 shares, and that's going to give us $4.90. Finally, we have this do-it-yourself exercise for the fourth learning outcome. Feel free to pause the video and give it a go yourself. Here we come to the end of today's lecture. I hope you guys have enjoyed it. And as always, feel free to ask any questions that you may have, and I will be glad to try to answer them for you. Thank you all for listening.